Welcome everyone. In this video we will address an important topic, much more important than it may seem, money management. Given the importance of this topic, I will be explicit and direct. I hope this lesson will be useful for you all. The purpose of this lesson is to be like an alarm clock that rings in the morning. Everyone is free to turn it off and turn to the other side of the bed or get up and look the sunshine over the horizon. The knowledge of the basic rules of money management is the only hope of salvation for most traders who use conventional technical analysis tools. Often, unfortunately, they even do not realize it. However, the great majority of traders believes that the key to success in trading is the ability to identify and define a valid strategy for entering or exiting the market. They study long hours over the books, discovering all the techniques in financial history, until they find the one that best responds to their conception and expectations from the markets. I should have entered here, I should have entered there, I could have closed here, etc., etc. These are the main sentences that are heard by those who look at what has already happened on the charts, even trying to derive a recurring pattern or a holy grail for the next actions. We must consider instead that the substantial difference between winning and losing is made by three things: the knowledge of what we are trading, the psychological attitude, the money management. All the trading techniques that are known and applied by the vast majority of traders, like cyclical analysis, crossing of moving averages, oscillators, statistical, volumetric, and volatility indicators, and so on and so forth, are by nature illusory. They are calculated on the price, and the price has already shown itself, as the price itself is the first derivative of monetary trades. The only certain fact is that over 90% of traders succumb to the market, and most of them never have time to learn from their mistakes. Some of them find themselves blaming the market on manipulations, machines, high frequency, etc., etc. However, hardly anyone does self-criticism. Hardly they try to understand what and why it went wrong. Hardly they realize that trading with the same old tools is trading in the dark. There is a main fact that we must always remember. The market is moved only by money and by the opposing interests of a myriad of operators, and a price will never know that it is at the end of a quarterly cycle, or that it has crossed a particular moving average, or that it has touched overbought levels on one of the infinite momentum oscillators. The market reacts only to the real monetary positions of the big operators, and these positions are anything but random, but are set up according to specific rules of money management and moneyness. This kind of traders are trapped in a short-sighted view of the market. The only salvation they have is the correct and consistent use of money management techniques. Only then they can stay afloat as long as possible. So, it is necessary for us all to open our mind and look beyond the same old colored indicator. We have to try to understand what are the real triggers that move the market and what are the big guys doing. Then we can also adopt the usual correct rules of money management, which would not be the last hope of salvation before the pit, but an extra tool we all should have in our toolbox. Money management is management of our free and invested capital. Proper money management is the difference between winning and losing. Correct trading on the market consists of 90% of money and portfolio management. This is a fact that most people cannot or do not want to understand. Because it is boring. It is nicer to glance at a chart with candles and good-looking colored moving indicators. Instead, money management is so boring. But once you have mastered the money management, discipline and psychology complete the shape of the good investor. It is very surprising to see that many traders have no idea what money management is. As the word itself says, it means capital management, that is, understanding how much of our capital must be used for each individual operation. Our capital is a scarce resource. The free capital is like the raw material for a production business. We cannot afford operations that, despite having a good chance of success, can jeopardize our capital. In other words, even if in the past a certain technique has proved us to be profitable, there is nothing to prevent that in the future the same operation could generate a loss, as each trade is independent. Therefore, it is imperative we master money management techniques and fit them to us. The money management is a set of rules that are used by the trader to know how much capital should he invest in each operation and overall. If things go wrong, the impact of the single loss should not affect the capital that much. Basically, money management is a system for maintaining risk at an acceptable level. So, it is important to tailor the rules to us. Every one of us has a different ability to absorb the shocks and the stress that derive from losses. Our emotional brain can lead us to make bad decisions. Risk must always be considered with the utmost respect. Whether we like it or not, it is our adventure companion, and it will always be present. So let's fix the first point. Protection and safeguarding of our capital. We have to manage our capital to maintain its efficiency. This is the only way to survive in the market long enough to be able to continue trading and hence earn our desired profits. If we are convinced of this, if we consider it much more important than desperately looking for a gain, then we are on the right track. We are not gamblers and we must be immune from the frenzy. It follows that, in trading, we have to take care of cutting losses and then subsequently optimizing profits. Losses, as you know, or should know, are part of the game. It is not possible to remove losses in trading activity. But we can manage and control them. Another concept to keep in mind is the drawdown. Drawdown is the amount of money that can be lost in trading, expressed in terms of percentage of the total capital available. We can talk about drawdown as the consecutive negative series of losing trades, or, just to have a geometric reference, let's say that the drawdown is the difference between a peak and a valley in an equity line chart. Well, the trading system that you intend to adopt, or that we have used up to now, must have a maximum drawdown that does not affect the efficiency of our spare capital. The drawdown represents the real black beast that the trader is confronted with. Sometimes it happens that the trader collects a series of winning trades that lead him in a short time to accumulate a substantial profit. At the same time, the trader develops a wrong psychological condition, a certain confidence in behavior, which leads him to underestimate the risks taken on the market. Then, inevitably, comes the negative streak. If this streak results in an abrupt and uncontrolled drawdown, the trader is swept away from the market. Game over. How many I know? These are not isolated cases, and it happens much more often than you think. Before going into the details of the money management rules, let's make an example. I want to show you the different approach taken between a beginner trader and a professional trader towards opening a market position. A beginner generally opens a position by focusing on winning, that is, how much he can earn. How many books tell us that we should teach our brain to think positive? Well, this type of mental attitude tends to greatly underestimate the possibility that the operation could generate a loss. Yes, you think positive, but you are losing. On the contrary, a professional trader opens a position on the market by focusing on the tolerable maximum loss. He is aware of the unpredictability of the market. He enters the market, bearing in mind the chance that his position may also generate a loss, for which he calculates exactly how much he is willing to bear it. In the first case, with the aim of obtaining large winnings, the risk involved is to take a position that is too large compared to the level of one's account. The result is that alongside more or less large winnings obtained through skill or luck, there will be large losses that will have a strong and negative impact on one's performance. This streak of losses will not only cancel what was previously earned, but even dig a hole into the account and lose more and more capital. The reason for this has to be found in a mathematical law that makes loss recovery very difficult. An increasingly higher performance is required, depending on the size of the loss. For example, if we were to lose 50% of the starting capital, we would have to earn 100% of the remaining capital to break even again. The chart shows us the drawdown curve and how the percentage needed to recover the loss grows exponentially compared to the percentage loss. This explains the reasons why losses must be kept at a very contained level, as is it relatively easier to recover. The approach of professionals follows precisely this criterion. Keep the inevitable losses at a contained level so as not to jeopardize their chance of recovery. Therefore, Professionals only open positions that are adequate to their total capital. They aim to realizing a series of small losses alongside a series of small gains, and then some isolated huge profitable operations that will make the overall performance skyrocket. So, our goal is to make a quantity of profitable trades higher than the losing trades. This, given the same value between wins and losses. If, when I win, I collect $1, and when I lose $1, it is clear that the only way I have to obtain an overall profit is to obtain a number of wins higher than the losses. Our second objective consists in achieving trades with unitary profits greater than the unitary losses. If, when I win, I collect $2, and when I lose $1, it is clear that, in the long run, I will be able to have an overall profit higher than zero. The optimal situation is the union of the two systems. There is more. When the market confirms our trading idea, we need to be able to have sufficient capital for the times in which it won't agree with us. For this reason, a trader must necessarily operate with a risk-return ratio possibly higher than 1, or with mathematical expectation higher than 51%. But what is the risk-return? The risk-reward is simply the ratio between the potential risk and the potential gain. The maximum risk for each operation, that is the maximum loss we can bear, should be predetermined by inserting a stop loss. The profit, on the other hand, represents the possible gain that can be estimated by establishing a price target. So once we open the position on the market, in addition to defining the extent of the stop loss, we must identify a target, that is, a point of arrival where we will take profit. Therefore, the professional trader is essentially a risk-averse operator that waits the time to enter the market with a minimum risk associated with a satisfying expected return. He is more careful not to lose than to try to earn, and he will never engage in senseless and high-risk operations, even if these could present a rather high expected return. At this point, let's fix another very important concept. In a game characterized by a negative long-term mathematical expectation, there is no money management system capable of making us win. Ultimately, even before opening any position, and therefore deciphering how much capital to use, we must start with a statistical advantage over the counterpart we are facing, that is, we must enter only when we have a competitive advantage over the market. In other words, we must have a system that is based on the mathematical expectation of a positive profit or a positive expected value. Here are the ingredients that make our trading consistent with the market, profitable and sustainable in the long run. Reading of monetary positions. Money management. Risk management. Positive expected value. And let's go into detail on the basic rules of money management. These are the common sense rules you will find everywhere. They are basic rules, built for that kind of little evolved trader who relies on colored indicators, on market analyses that are based on correlations of time and price, to all those who believe that prices know Gann and Fibonacci. The only hope these traders have of staying in the market is to respect these rules. Risk, a maximum percentage of 2% of the capital available for each transaction. Be invested, at most, with 20% of the portfolio. Before opening a position, always evaluate the volatility of the market. The greater the position, the lower the risk level must be. Never increase or average down a losing position by adding more capital. Do not proceed with mental stops, but place sell orders. For the others, those who know how to look where they need to, the rules of money management are different, and we will address them in our operational videos on MC4 trading system. We will explain in depth how much maximum margin to use, which tools to use, whether to prefer debit or credit strategies, and why. Each of the triggers in MC4 trading system has a very specific rule, an operating methodology, and a precise money management. Thank you very much for watching. See you in the next videos.